You can't afford to buy a house. Here's the part that'll really get you. You can't afford to sell one either. The UK housing market hasn't crashed. It's done something stranger than that. It's frozen, solid, at both ends at once. The first-time buyer is locked out. The person desperate to move up is locked in. And everyone standing in the same queue asking the same thing. If nobody can afford to buy, why is the price still sitting there like it's 2021? Once you see what's actually holding that price up, you'll never look on Rightmove the same way again. Start with the simple question, why have prices stopped going up? The Bank of England's base rate is sitting at 3.75% as of June 2026. That's the rate that quietly sets the price of borrowing and saving for every bank in the country. And borrowing is just a posh word for your mortgage. Higher base rate, higher borrowing costs. The average 2-year fix is hovering around 5.68%, the 5-year fix about 5.63%. Those are averages. Yours shifts with the size of your deposit. Now watch the chain reaction. Borrowing costs more, so your monthly payment goes up. Your monthly payment goes up, so the loan your salary can stretch to goes down. And when buyers can borrow less, they have to offer less. Not out of spite, not hunting for a bargain, but because the bank won't lend it to them, and they couldn't make the repayments anyway. So nationally, prices have basically flatlined, up about 1.5% over the year, which, once you take inflation off the top, is actually going backwards in real terms. That's the surface story. The machine running underneath it is the bit that matters. Forget the textbook for a second. Supply and demand isn't a graph, it's an auction. Picture every house for sale as a room full of buyers with their hands in the air. Nobody sets the price. It just keeps rising until everyone's dropped out, except the one person willing and able to pay the most. That last hand still up, that's your price. Cheap money inflates that room. When mortgages were near 2%, your salary could service an enormous loan, so you could keep your hand up far longer than your income had any business allowing. Loads of hands stayed up, prices floated. Then rates tripled. Now the same salary services a much smaller loan. Hands start dropping, the room empties out, and the price where the auction finally clears, it quietly drifts down. That's the whole thing. Prices don't fall because the houses got worse. They fall because the money that was inflating all that bidding just got switched off. Now it gets personal. Because there are two things you pour into a house, and both of them have shrunk. Think of buying a home as injecting capital, which is just a fancy way of saying how much money you can throw at the thing. And it comes from two pots. Pot one is your deposit, the cash you've scraped together. Pot two is the loan your salary can keep paying every month for the next 30 years. Hold those two pots up against your pay. The average full-time salary is about £39,000. The average home costs roughly 7.6 times the median full-time salary. Salaries have crawled. House prices sprinted for a decade and then sat down to catch their breath. So the gap is still enormous. And high rates make it worse because more of your monthly payment now disappears into interest instead of going toward what you can actually borrow. And the deposit? The average first-time buyer now hands over around £61,000. At a normal saving rate, that's roughly 6 years of putting money aside. 6 years. While rent quietly eats the very savings you're trying to build. So remember that room full of raised hands? This is why the hands are dropping. People simply can't inject as much capital into a house as they used to. Smaller deposits, smaller loans, lower bids. But there's a second lock on that door. And this is the one that really freezes the market shut. Even if you've got the deposit and the salary, the bank still has to say yes. And the rules are built to make saying yes hard. There's a thing called the loan-to-income cap. Lenders can only hand out a limited slice of their mortgages, about 15%, to people borrowing more than 4.5 times their income. Some now stretch to 5.5 times for the right borrower, and the Bank of England is even talking about loosening the cap. But income multiples aren't the only hurdle anymore. There's still the affordability stress test. The bank doesn't just check you can pay today's rate. It checks you could still pay if rates climbed higher, and it weighs up whatever other debt you're already carrying. So you get priced against a payment bigger than the one you'll ever actually make. Run the maths on a £39,000 salary. 4.5 times income is about £175,000 of mortgage. Add the deposit you've spent 6 years scraping together, and in half the country that still doesn't buy the average home. So, you can't buy a house? This is why. It's not just the price tag. It's that willing buyers with deposits in hand get turned away at the counter. The door isn't just shut. It's locked from the inside. And here's the bit the price tag never shows you. Even if you do get past the bank, the cost of buying itself has quietly crept up. Start with stamp duty. Back in 2024, you paid nothing on a home up to £250,000. Then, from April 2025, that threshold snapped back down to £125,000, and it stayed there ever since. So picture buying the average UK home at around £272,000. You now hand the taxman roughly £3,600 in stamp duty. That exact same house 2 years ago, about £1,100. Same bricks, 3 times the tax, and you've got to find it in cash, on top of the deposit. First-time buyers get a break, but a thinner one than before. The relief now runs out at £300,000, down from £425,000. Buy above that in a pricey area and the tax starts biting. Then there's everything that doesn't show on the sticker price at all. Conveyancing and legal fees. A survey, so you don't buy a money pit. The mortgage arrangement fee. Often around £1,000, bolted straight onto the loan. None of it is the house. All of it lands on you before you've even turned the key. So remember that locked door? Stamp duty and fees are just another set of bolts on it. The monthly mortgage grabs all the headlines, but these stack on quietly, right on top. And that frozen door doesn't slam equally everywhere. This is where the crash headline completely falls apart. Because there isn't one market. There are two, running at completely different speeds. In London, prices fell about 2.1% over the year, the 9th month in a row going backwards. The expensive south is sticky, slow, drifting downward. Now turn north. The northeast, up nearly 10% over that same year. Scotland, Wales, the northwest, all growing faster than the national average. Why the split? It comes right back to that capital injection. Up north, prices sit at a sane multiple of local wages, so people can still get their hands up at the auction. Down south, prices ran so far ahead of salaries that high rates simply emptied the room. So next time a headline screams, house price crash, fire one question straight back. Which house and where? Because a flat in Zone 4 and a terrace in Sunderland are living on completely different planets right now. Right. So what does this frozen market actually mean for you? It all depends which door you're stood at. If you're a first-time buyer, the brutal news is the deposit. The slightly good news, for the first time in years, prices aren't sprinting away from you while you save. In some regions, they're even drifting back towards you. If you're a would-be seller hoping to move up, you're the one who's locked in. You might not sell for what you wanted, the market has moved, and the bigger place you've got your eye on now costs a fortune to finance, so you stay put. That alone is half the reason so little is up for sale. The freeze isn't just buyers, it's millions of people quietly deciding, not now. And if you're heading into a mortgage renewal, this is the one biting hardest, and barely anyone's talking about it. You borrowed at 2 point something. You're renewing at 5 point something. Same house, same loan, hundreds of pounds a month more for absolutely nothing extra. That's the rate rise finally landing in your bank account. Late, but very real. So what do people tend to actually do in a market like this? First, don't sit around waiting for a crash that the 2-speed data says isn't really coming nationally. You could rent for years betting on a number that may never print where you live. Second, if you're buying, fight the battle you can actually win. The deposit. Every £1,000 you save is £1,000 you don't borrow at 5 point something for the next 30 years. Boring beats clever here, every time. Third, if you're renewing, start shopping 3 to 6 months before your deal ends. Lock in early and never just roll onto your lender's default rate. That one's designed for people too busy to look. And whatever you do, build the emergency fund before you stretch to the absolute top of what the bank will lend you. The bank's stress test protects the bank. Yours protects you. So here's the reframe. A frozen market sounds like a disaster. For a forced seller, it genuinely can be. But for most people, frozen isn't a crash at all. It's the air slowly hissing out of a balloon that a decade of cheap money pumped up way too far. Because the thing that really inflated those prices was never demand. It was cheap debt. Hand people cheap borrowing, and they'll use it to fund expensive things. Make the debt expensive again, and the price has to drift back down to a level real wages can actually carry. Which, by the way, is one of the very things that triggered the financial crisis in 2008. It's not a catastrophe, it's just gravity getting switched back on. So no, the housing market hasn't crashed. It's frozen, lopsided, and quietly resetting toward what people can actually afford to pay. Watch the rates, watch your region, and never bid on a story when you're the one left paying the mortgage. If this made the headlines make a bit more sense, subscribe. That's the whole channel.